Hello, in this lecture we will continue on Chapter 8 talking about control of cash receipts. So cash receipts by mail. So we discussed before a cash register system. Now let's take a look at a system in which we send out an invoice and then we receive payments in the mail. How can we have the same internal control procedure being separation of duties being the major principle we're putting into place in order to put safeguards within the cash system? Note once again that this is a system that requires more people in order to do it and therefore would be more relevant in larger companies, and it does take longer and it is a piece of bureaucracy. The question always is, how much of these internal controls do we need in order to properly safeguard the system? And as the company grows, the more we will then need. So if we're going to receive cash within the mail, then we have preferably two people are assigned the task of opening the mail. Why? Because we want two people involved so that they once again would have to collude in order to steal any stuff coming in from the mail. The people that are handling the cash from that point would then make a list of the cash receipts and who it was received from. They would make triplicates of that cash receipt. They would keep one copy, put another copy to the cashier department, the cashier, and then they would give another one to the record keeper. Then the cashier would then be the one that actually deposits the check into the bank, and the record keeper would be the one that records the cash deposits, records the actual journal entry. In doing so, we have a separate person depositing it from the bank, then is opening, and we have a separate person that is then putting the transaction into the system, then is handling the records. So note that this person over here doesn't have access to the cash at all. They're putting the records into the system. What will happen then is at the end of the month, we're going to reconcile the cash account, and then the deposits that we have put into the bank then will need to match the actual deposits, or else the records will have to match the deposit into the bank, or else we will have an issue. That's how we're going to detect some problems. What are some problems with this type of system? Just as any system, it can be circumvented with collusion, with departments getting together and colluding to circumvent the system. So that's what always going to be a problem with the separation of duties. It is relevant to do this and very useful to do this as companies grow, because it is a lot less likely for two individuals to collude in order to circumvent the system than if we had it all in one individual's spot. We know that if the opportunity is very available there, and we combine that with other circumstances, then fraud and theft, these types of activities are more likely to happen. By putting in safeguards and separation of duties, that makes it much less likely to happen and give much less of an opportunity for things like fraud and whatnot to happen. Once again, note that it does take a larger accounting department in order to do this type of separation of duties. Control of cash disbursements. Control of cash disbursements is especially important as most large thefts occur from payment of fictitious invoices. So a lot of times a theft could happen not on the receiving end, but on the disbursement end. So we are, for example, issuing checks to individuals that should not be receiving checks, or a fictitious service or a fictitious product that has been bought by the company. How could we safeguard against the cash going out? Well, keys to internal controls: cash disbursements require all expenditures to be made by check. We want as few as possible to expenditures to be made by cash. We may have a petty cash fund, but we are generally going to spend the petty cash fund on very small items and we're going to regulate how much is in a petty cash fund. Other than that, we want it by check. Why do we want it by check? Because there's a paper trail there. Where's the paper trail? The bank. The bank is recording all transactions along with us, and therefore if we needed to go back and check our records, we can also check the bank's records, and we can compare those two records and say, okay, this ties out to the bank's records, therefore it looks correct. Limit access to checks except for those who have the authority to sign checks. So only certain individuals should have checks. Notice that checks are not something that are generally printed from a system. Even if we have a system like QuickBooks, we don't print the entire check from a blank piece of paper. you would think, well, the system is capable of printing a check from a blank piece of paper. Why don't we do that? Because we want to have pre-numbered checks from the bank, and if they are pre-numbered, then we can see that if someone stole a number, rather than if they were printed from a system, it's possible to change the number. So we generally, even if we're printing from a computerized system, we'll still have checks that are outside of the system that we will then print on with the preset numbers, and we want to put those checks in a lockbox or somewhere. And if there is a theft, then the number in the system, the check number, will not match the physical checks. That's one indication that some checks have been written and dispersed that are not correct. We could also have a voucher system. A voucher system establishes procedures for verifying, approving, recording obligations for eventual cash disbursements. So we'll take a look at the process in a larger company to both approve the purchase and then approve the checking process. And then we have issuing checks for payments of verified, approved, and recording obligations. So then the actual issuing of the check. We'll take a look at the larger voucher system in a second. I do want to point out that even for a very small company, certain controls over cash are very important, and the cash going out is a simple control that a small company can make, and that would be that if we have an accountant or a bookkeeper doing our books, at the very least, we want them to create the checks but we do not generally want them to sign the checks or rubber stamp the checks. We want them to generally often have to get approval from the owner or someone in charge in order to sign the checks, so that you have that type of verification, that approval, before the check goes out. So for any size of business, that simple internal control is relevant. It's one that often is not done, surprisingly, and it is an important control to keep even in a small business. In a larger voucher type of system, in which we were going to request information, we could think of the folder like this. We have the sender and the receiver, but this is within our company. So we could start off with a request. We're going to have a purchase request. A certain department needs something. They're going to have a purchase request. Where's that request going to go? It's going to go to the purchasing department. We're going to have a full department for purchasing, and it's going to go to the accounting department, who of course will record the request. Then we've got the purchasing. Here we'll send out the purchase order. That's the job of the purchasing department. Where will the purchase order go? We're going to have a supplier is going to get the purchasing department purchase order, and the supplier being who we're going to buy the thing from. So that's our vendor. That's the person we buy the thing from. The department requesting is going to get a copy. The purchase department saying, okay, I got your thing, I'm sending it out. And then receiving, the people that are going to receive it, if it's going to be received in a warehouse or some official place, in the mail room, wherever the receiving area will be, we'll send them a copy and say, hey, you're going to be getting something soon if this purchase order goes through. And then we're going to send it to accounting in order to record that. Then the supplier, the vendor, the other company, will then send us an invoice. So they're going to send an invoice to us. So we sent the purchase order requesting it. They then send us an invoice. And then the receiving department, and of course the invoice is going to go to the accounting department. And then the receiving department, being the mail room or the warehouse, the place that receives stuff. So if it's coming in a truck, the truck came in, received our stuff. The receiving department will often be in charge of counting the items, making sure that, at least counting the items and seeing what we received, have a receiving report, and the receiving report will then go to the accounting department, the requesting department, those are the people that originally requested the item here, and the purchasing department, because the purchasing department are the ones that did the purchase order, and then the accounting department will have the invoice approval. They will often take the receiving report, compare it to the purchase order, and see that we received what we should have, and make sure that everything is there. Then they're going to go to the cashier, and the cashier then will prepare the check, which will eventually go to the supplier. And of course the check would have to be approved and whatnot and signed before it went out. So clearly this is a fairly long process, you can see, but it does have the proper separation of duties and approval process, which can give the safeguards necessary for a larger company to give that approval process to properly order something and receive it and verify that the process has taken place and we have received what we intended to receive.